If you hear the words capital advisor or M&A advisor and instantly picture a skyscraper boardroom and billion-dollar deals, you're not alone. But here's the truth. You don't need a massive company to benefit from an advisor. In a lot of cases, small and mid-sized businesses have even more to gain. Because the stakes are personal, the margin for error is thinner, and one deal can change everything.
And we're not just talking about selling your business someday, right? This is also about raising growth capital, refinancing, buying a competitor, bringing in a minority partner. All those moments where you're making a decision that can either accelerate the business or become a regret you carry for years.
Exactly. Today we're going to break down why small and mid-sized companies should consider a capital or M&A advisor, what these advisors actually do, how the process works, what it costs, how to choose the right advisor, and how to work with them in a way that leads to a real win, not just a deal that closes.
Let's start simple. What does an M&A advisor actually do in plain English?
In plain English, they run a professional process, so you don't have to improvise with one of the biggest transactions of your life. If you're selling, they help you position the story, identify and approach qualified buyers, manage outreach, handle back-and-forth conversations, drive competition, coordinate diligence, and negotiate terms. If you're buying, they help you target deals, evaluate them, negotiate, and avoid common traps.
And a capital advisor?
Similar concept, different objective. They help you raise money or structure financing, whether that's debt, equity, or something in between. And not just find an investor. They help you figure out how much you should raise, what it should cost, what terms are realistic, and who is actually a fit for your business.
So why do small companies in particular need this? Because a lot of owners think, I can just talk to a couple of buyers, or my banker knows someone, or my attorney can handle it.
That's one of the big misconceptions. Attorneys are essential, but they're not process managers or market makers. Bankers can be helpful, but they're not always building competitive deal tension. And when an owner tries to DIY it, a few things tend to happen. First, you get one or two conversations going, and you treat interest like certainty. A buyer says, "We're very interested," and suddenly you're mentally spending the money. But interest isn't a signed LOI, and an LOI isn't closing. Second, the buyer controls the timeline. They drag diligence out, chip away at price, and you're stuck because you didn't build options. Third, you accidentally share sensitive information too early or with the wrong party. And in small markets, word travels fast.
And fourth, you're running your company at the same time. That's the part one think people underestimate. Even if you're smart, even if you're a great operator, deal work is a second full-time job.
Yes, and performance matters. If revenue dips during a sale process, buyers notice. If margins slip, buyers push price down or demand tougher terms. An advisor can absorb a huge part of the deal workload, so the owner stays focused on keeping the business strong.
Okay, so what are the clearest moments when an owner should say, this is advisor territory?
Here are a few. 1. You're thinking about selling in the next 12 to 36 months, and you want to maximize value and reduce surprises. 2. You've been approached by a buyer and you're not sure their offer is fair, or if you're missing a better path. 3. You want to raise growth capital, but you don't know whether debt, equity, or a combination makes the most sense. 4. You're considering acquiring a competitor or adjacent business, and you want to avoid paying too much or taking on hidden liabilities.
I'd add a fifth. When the deal outcome impacts your personal life more than your business life. Like retirement plans, family, succession, passing the company to the next generation. Those are emotional decisions, and emotions can be expensive in negotiations.
Absolutely. And that's where a good advisor adds a sort of emotional buffer. They keep you from reacting and help you stick to a strategy.
Let's talk about what success looks like. People think success is just a higher price. But that's not the whole picture.
Exactly. Price matters, but structure matters too. A deal with a high headline number can be a bad deal if it's loaded with earnouts, aggressive working capital terms, or conditions that make it hard to actually get paid. Success is usually some combination of the right valuation, the right terms, the right buyer or capital partner, a reasonable timeline, limited disruption to the business, and a closing that doesn't implode at the finish line.
So let's walk through an effective process for engaging an advisor. If someone listening says, "Okay, I'm open to it. Where do I start?"
Start earlier than you think. The best time to meet advisors is before you're forced into speed mode. Even a light initial conversation can help you understand readiness, valuation ranges, what buyers might care about, and what you should clean up before going to market. Then build a short list. Talk to at least 3 advisors if you can. Not because you want a beauty contest, but because you'll learn quickly how different their approaches are.
And what should owners ask in those first meetings?
A few practical questions. Ask, what kind of deals do you do most often? Size, industry, sell side, buy side, capital raises? Ask for a couple of examples that sound like your situation. Ask how they source buyers or investors. Ask who will actually do the work day to day. Because sometimes you meet the senior person and get handed off to someone else. Also ask how they think about valuation. Not promise me the highest number, but how do you build a credible value story and create competition?
And fees. People are often awkward about fees, but you have to be direct.
You do. Most commonly, you'll see a monthly retainer plus a success fee when the deal closes. The retainer covers actual work happening now. The success fee aligns incentives toward closing. But you want clarity on what triggers the fee, what counts as a transaction, how expenses are handled, and what happens if the deal changes direction.
And to be fair, owners should view this like any other investment. The question isn't, can I avoid paying a fee? The question is, will this advisor increase the odds of a better outcome enough to justify the cost?
Right. If an advisor helps you create a competitive process that improves valuation or terms, they can pay for themselves many times over. Or even more importantly, if they help you avoid a bad deal, that can be priceless.
Let's move into working with an advisor. Let's say you hired one. What makes that relationship work well?
The biggest thing is alignment up front. Get clear on the goal. Is it the highest price, the best cultural fit for employees, the shortest timeline, the least personal risk? You can't optimize everything simultaneously, so you need priorities. Second, responsiveness. Deals move on momentum. When an advisor asks for financials, customer concentration data, backlog reports, or forecast, speed matters. You don't need perfection, but you do need forward motion.
Third, honesty. If there's a problem in the business, say it early. A customer that might leave, a lawsuit threat, a margin issue, a key employee who's unhappy. It's better to build a narrative around reality than to have a buyer discover it mid-diligence and assume it's the tip of the iceberg.
That's a great point. Buyers don't expect perfection. They expect transparency and a plan.
Now, can we talk about a common fear? A lot of owners worry, if I hire an advisor, they're going to push me into selling or they'll chase a deal even if it's not right.
That can happen with the wrong advisor, which is why selection is everything. In a good relationship, the advisor is a strategist, not a pressure machine. You should feel like you can say, "We're pausing," or "That buyer doesn't feel right," and the advisor adjusts. And you can protect yourself structurally, too. Make sure your engagement terms are clear, understand a timeline, and be specific about what counts as success. Also pay attention to whether they ask thoughtful questions about your goals, or whether they jump immediately to pitching you a process.
Let's get tactical about the process itself. If you're selling a business, what are the phases where a good advisor makes the biggest difference?
Phase 1 is preparation. They help you assemble clean financials, normalize earnings where appropriate, and craft a story. Not a fairy tale, a credible narrative. What you do, why you win, how you grow, and what a buyer can do with the platform. Phase 2 is outreach and managing the funnel. This is where experience matters. They know how to contact buyers, how to qualify them, how to prevent time wasters from eating your calendar, and how to keep multiple parties moving at once. Phase 3 is negotiation and diligence management. When diligence starts, it can feel like death by 1,000 requests. A good advisor helps translate requests, set boundaries, maintain leverage, and keep timelines realistic. And the best ones anticipate where deals usually break and address those issues early.
And if you're raising capital?
Preparation still matters. You need a clear plan for what the money does, how it changes a business, and what the repayment or return looks like. Then it's about targeting the right capital sources. Not everyone is right for your size, your industry, or your risk profile. A good advisor narrows a list and runs an organized process, so you're not having random one-off conversations that go nowhere.
Let's talk about red flags. What should listeners watch out for when picking an advisor?
One big red flag is guaranteed outcomes. If someone promises a specific valuation or says they already have a buyer ready without understanding your business, be skeptical. Another red flag is vague process. If they can't explain the steps, timelines, and deliverables, that's a problem. Also listen for whether they understand your industry fundamentals or at least demonstrate a strong ability to learn. And pay attention how they talk about confidentiality, especially for smaller businesses where employees and customers can get spooked.
I'd add, watch for ego. If the advisor makes it all about them, you're going to have a tough time. This should be about your goals, your company, and your risk tolerance.
Totally. This is an intimate process. You're sharing financials, customer dynamics, maybe family considerations. You want someone you trust.
All right, before we wrap, let's give listeners a simple action plan. Suppose they're $5 million to $50 million revenue business and they're curious about capital or an eventual sale. What do they do this month?
Here's a solid 4-step plan. Step 1. Write down your top 3 objectives. Not generic ones, real ones. Like, I want to de-risk personally, or I want to fund a second location, or I want to exit in 2 years but make sure my team is protected. Step 2. Pull your last 3 years of financials and your most recent trailing 12 months. Even if they're imperfect, get them organized. If your books are messy, that's not a reason to avoid advisors. It's a reason to start to clean up sooner. Step 3. Identify 3 advisors to talk to. Ask your CPA, attorney, lender, or other owners for introductions. But don't stop there. Do your own research too. Step 4. Take 3 introductory calls and ask the same core questions each time. Compare how they think, not just how they pitch.
And if the conclusion is, we're not ready yet, that's still a win. Because now you have a roadmap for what ready means.
Exactly. Hiring a capital or M&A advisor isn't about pretending you're a huge company. It's about respecting the size of the decision you're making. Small and mid-sized businesses deserve a professional process just as much as anyone else, maybe more.
Because for a lot of owners, this isn't one transaction among many. This is the transaction.
That's it. If you're considering raising capital, buying a business, or selling your company in the next few years, don't assume you have to do it alone. Build a team, run a smart process, and give yourself the best shot at a great outcome.